Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Today will be a quick but informative webinar to determine if the S&P 500 technology sector is overvalued in both absolute terms as well as relative to the S&P 500. Let's go ahead and get started. The very first chart we're going to look at is a 20-year history of the PE ratio for the S&P 500 technology sector. I want to call everyone's attention to this multiple expansion we've experienced since the beginning of the year, this against the backdrop of quantitative tightening and the most aggressive Fed rate hike cycle that we've experienced in over 40 years. This valuation expansion all the way to a PE ratio of 29 times on forward earnings is in stark contrast to the backdrop of the Fed policy that we had in place here post-COVID. You can see those valuations are roughly the same. We're sitting at peak levels, even with this restrictive Fed policy. So when we look at this in terms of statistical analysis and we do our measures of central tendency, you can see that I've got 5 horizontal red lines up here. The very middle one is just simply the average or the mean. And you can see +1, -1 standard deviations, +2, -2 standard deviations. And these are literally just measuring the variability around the mean. Once you get to these outlier areas, these +2, -2 standard deviations, you're really getting to these extreme levels where you can expect mean reversion to take place. And so doing a simple disaggregation of the PE ratio itself will give us an idea of what we need to look for in the coming months. We can get a mean reversion out of the IT sector by simply having the tech sector sell off. In other words, price declines relative to earnings, that multiple contracts. Okay, we approach the mean. The next thing that can happen is that prices could more or less stay flat, or they can even increase. At the same time, though, earnings could increase at a faster rate. This would be what we call a valuation catch-up, where multiples would then compress because earnings growth is accelerating. Okay, so we need to see 1 or 2 of those scenarios play out for this scenario to more or less mean revert. So technology sector, again, relative to its 20-year trend, very, very heated. And we're going to be looking for that to mean revert here over the coming months. We'll see what happens. Next slide, we're going to look at the second chart is going to be a 20-year history of the S&P 500 PE ratio. And what I want to call your attention to here is that we're sitting at a very critical inflection point, right? So at more or less 19 times, this valuation level, if you will, prior to COVID would mark market peaks in terms of valuation. So you can see that here, end of 2017, S&P 500 hits the 19 forward multiple and then begins to mean revert. Same thing here prior to COVID. Actually, COVID more or less caused this one. But you can see we're right back at that 19 level. Again, not at a +2 standard deviation like the tech sector, but it's interesting to note that we are sitting at levels that did mark prior market peaks, okay, even more so than even off the back of the dot-com bust here in 2003, okay? So for the S&P 500, the median coming in at 15.6. You look at the average is about 16. We're currently trading at about a 19.2, 19.3. So again, we'll be looking for mean reversion here. What does this look like? Simply disaggregate the PE ratio. Prices can fall, perhaps off the back of a tech-led decline in price. The other thing that can happen is that earnings can accelerate, or what we call a valuation catch-up, where we have earnings growth where price maintains, stays flat, or actually increases, but earnings increase at a faster rate. That would also cause this ratio to mean revert. So we'll be looking at that. Third chart is very, very unique in that we actually take the 2 prior charts and simply divide the 2. So we create a ratio of the PE for the IT sector and the S&P 500. So we're simply dividing the 2 series. And when we do this, we get a very unique phenomenon. We end up neutralizing the effect of all of the macroeconomic factors that impacted PE ratios for each of the underlying series, right? So how does this work? Well, we have varying degrees of interest rates in here. We've got a Ukraine war. We had a Great Recession. The idea is that if we do relative analysis, right, we can neutralize the macro economic impact to where we just literally get down to the raw fundamentals. We call this more of an organic valuation measure. And how does that work? It's very simple, right? The war in Ukraine, the Great Recession, it impacted both the numerator and the denominator of the ratio since we're doing a relative analysis here. The tech sector was impacted. The S&P 500 was impacted. You divide the two series. Those obviously neutralize one another, and you're left with basically just the company fundamentals themselves. And you can see that that tech sector relative to the S&P 500 surging past +2 standard deviations, even higher than the highest point off the back of this supportive Fed environment here off the back of COVID. So you can see that even in this relatively restrictive Fed environment with quantitative tightening and the fastest rate hike cycle we've seen in 40 years, those tech valuations are just surging, okay? So the idea here, when you look at the chart, how do you make sense of this, right? It's the same thing. We've got our mean or our average. And basically what this is telling us is that the average is for the tech sector to trade at about a 10% valuation premium to the S&P 500. You can see that here with 1.1. It actually also equals the median here, 1.1, right? So we're just literally subtracting 1 away from that. And you can see that we're currently trading at a 50% valuation premium. Okay, so certainly some mean reversion here is probably due, and that's what we're going to be looking for. And again, it can take place in many different ways. Obviously, if you take a look at the ratio itself, you can get a collapse in tech sector valuations relative to the S&P 5 that would cause us to mean revert, or the S&P 500 itself could rally X tech, and that would bring this ratio down as well. Okay, so given the fact that the S&P 500 is already trading at +1 standard deviation relative to its 20-year average, right? We looked at that in the prior slide. How does the valuation of the tech sector look trading at a 50% valuation premium to the S&P 500, right? We just looked at that. How is the upcoming NASDAQ 100 rebalance going to impact valuations of the tech sector? Okay, these are the questions we've got to ask ourselves. Relative to long-term trend, right? We know that corporate expectations over the next 12 months are going to be critical for current valuations to hold, right? We talked about that in absolute terms. If these corporate earnings expectations don't hold over the next 12 months, we can expect that rollover in price. So what if you could reduce or even eliminate the worry over where your portfolio earnings are going to be over the next 12 months? Right? At Pacific Point, we have a proprietary stable earnings portfolio strategy we think you will find more appealing than traditional asset allocation models anchored by the S&P 500. Why is this, you might ask? Because our Pacific Point stable earnings portfolios are designed to exhibit steady underlying portfolio earnings growth with the potential to meet or exceed market returns. And you get all of this with lower levels of risk than the overall market. The timing couldn't be better, as all three of our stable earnings family of core equity portfolios are currently trading at valuation discounts relative to the S&P 500. This represents a timely and unique entry point to take advantage of the peace of mind that stable earnings portfolios can provide over the long run. You can find out more about our stable earnings portfolios by visiting our website at www.pacificpoint.net. And be sure to stay tuned for upcoming webinars where we will explore the upcoming NASDAQ 100 rebalance, as well as the relative valuations of each of the Pacific Point stable earnings core, dividend, and ESG portfolios. If you are a financial advisor or an individual investor and would like more information on how you can work with Pacific Point advisors, please contact us at 858-356-6600 or email us at info@pacificpoint.net. Be sure to visit the Pacific Point Research Lab on our website. While you're there, sign up to receive our research delivered directly into your email inbox. You can also connect with us on LinkedIn at Pacific Point Advisors, LLC. Thank you all for attending. We'll talk to you next time.